Hello everyone, welcome to Yadnya Investment Academy. Today we are going to talk about tax treatment of gifts received by an individual or HUF, basically gift tax. We have divided this topic into 3 videos. In part 1, that is the current video, we will discuss about features of gift tax rules. In part 2, we will discuss in detail about tax implication of various parties involved in gifting process, and will also discuss in detail about income clubbing provisions. And in third part, we will talk about tricks to save tax through gifting. Now let's discuss the key features of gift tax rule. Do you know when someone deposits some money in your bank account, it has a taxation angle? Let's see examples of few of such situations. You asked rupees 60,000 as loan from your friend and paid him back after 1 month. You got 30,000 rupees in your bank account from your spouse when you were traveling. Third situation could be you swiped your credit card for your friend rupees 50,000 purchase, and then your friend paid back money to you by transferring it to your bank account. And the fourth situation could be your father transferred rupees 70,000 in your bank account for your upcoming home loan EMI. These are few instances which happen in our daily lives, but it's very important for us to understand the tax implications in various scenarios and the possible issues which can come up in future if income tax department decides to scrutinize our income tax returns. So now let's look at points which will help us understand rules about income tax on gifts in a better way. The first major rule which we should know is that there is no tax to be paid on gifts received if the amount of the gift is up to rupees 50,000 a year. Gifts here means gifts received as cash, kind or property without consideration. Without consideration means when there is no consideration to pay it back. Now there is a small catch here. If the total amount crosses rupees 50,000, then you will have to pay the tax on the total amount received, not the additional. Let's understand this with an example. If suppose in current financial year, a friend A gives you a gift of rupees 20,000 and friend B gives you a gift of rupees 25,000, then you will not have to pay any tax as the total is less than rupees 50,000. Now if suppose friend C gives you rupees 50,000 more in the same financial year, then the situation becomes tricky. Your total gifts in a year is now rupees 60,000. Now you will have to pay tax on the total amount of rupees 60,000, not just on the additional 10,000 over above 50,000. This whole 60,000 will be included in your income and you will have to pay tax on this rupees 60,000 as per your existing tax slab. Second important point in income tax on gifts is that any amount received from specified relatives is totally tax-free in the hands of recipient. So if a relative gives you a gift in the form of cash, check or any other kind, you will not have to pay any tax on the amount received. And there is no maximum limit on the value of gift received to be exempted from gift tax under this point. Income Tax Act has also clearly given the definition of relatives here. If any of these individuals give you a gift, you don't need to worry about the taxation part because it's a gift from your relatives and you will not have to pay any tax on this amount. One thing to note here is that in these transactions there may be times when income clubbing provisions may apply. We will talk about income clubbing provisions in detail in our part 2. One of the few advantages of getting married is that any amount you get as wedding gift is not taxable in your hands either from relative or non-relative. So if your friend is feeling generous and decides to give you a gift of rupees 5 lakh on your wedding, then it will not be taxed in your hand. Now let's discuss a particular aspect of gift tax on movable and immovable property. Immovable property means any real estate, and movable is all the other gifts except real estate. We are going to discuss of one aspect here, that is gifting for consideration. Let me directly explain this with an example. If suppose Mr. A sells a property to Mr. B at rupees 30 lakhs, but the stamp duty value of that property is rupees 32 lakhs. Now since Mr. A has sold the property at lesser the price of current stamp duty value, in the eye of income tax department, these difference of rupees 2 lakhs will be considered as gift. If Mr. A and B are not related, then Mr. B will have to pay tax on this rupees 2 lakh since it is greater than the gift tax limit of rupees 50k. But if Mr. A and B are related as per the definition we have explained before, then of course there will be no tax. We can take a similar example for a movable property also. Only difference will be there, instead of stamp duty we will be considering the fair market value of the product. Any amount received under a will or by way of inheritance is fully exempted in the hands of the person receiving the gift. There is no maximum limit in this case, and the whole gift received is considered as tax free. There are also few tax exemptions we get if we get gifts from local authorities, few foundations, hospitals, educational institutions, etc. We are not discussing them here in detail as this happens in very rare cases, and if you want more information you can refer to Income Tax section 1020 and section 1023C. If gifting amount is big enough, then it is a good habit to have a proper documentation, because sometimes the income tax scrutiny comes for past years and it becomes very difficult to remember few transactions and we end up paying more tax. Gifts made by way of cash or check does not mandatorily requires to be executed through a gift deed. Writing on a plain paper with signature mostly suffice. If gift is a movable property such as very expensive jewelry or a watch, then it is a good habit to put the transfer on a stamp paper and get it notarized. For immovable property such as real estate, of course you will have to get it registered as registration is required as per the law. So as far as you make the transactions which can be justified, there is not much to worry about. However, it is always a good and safe practice to document things. This is all on part 1 of this topic. In part 2, we will discuss about how to save tax through gifting and also about income clubbing provisions in case of gifting. Hope you find the info useful. If you have any question or feedback, please do write in the comment section below. Have a great time ahead.